The Financial Survival Network, helping you survive and thrive in the new economy. For a free financial survival toolkit and newsletter, sign up at kerrylutz.com. KERRYLUTZ.com.
1490 WGCH. This is Kerry Lutz. You're listening to the Financial Survival Network. My next guest, Ron Hera, an economic expert and devotee of the Austrian School of Economics, as am I, publishes a newsletter, has a great website. Ron, thanks for being on.
Thanks for having me on.
Hey, we were talking about Austrian economics and the collapse of the system that's in place now. What's your take on it? Is there any hope of saving this fiat monetary-based system?
Well, I actually think that it could go on for some time. I mean, we are caught in the grip of history, in my opinion, and in the future, historians will look back and they will see this period of history as an event, and it will be discussed in that sense, just as we discussed the Great Depression as an event that happened in the past. However, for those of us who are, for better or worse, living through this event, it is actually a rather long, drawn-out process. And fiat currencies always die, but mathematically speaking, they simply trend towards zero. And at some point, there might be a loss of confidence. The necessary result is some type of revaluation. Just as a practical matter, people don't want to work with very large numbers like trillions. So the currency will have to be revalued, and that's true for any fiat currency. It could also fail in a hyperinflationary collapse. That's a definite possibility. And as you know, there's been a great debate over inflation versus deflation. It's one of many topics where there's a great deal of confusion.
And what is your take on the inflationist versus the deflationist view?
Well, so first, just very briefly, there's essentially 6 permutations. So you have inflation or deflation, and that could be in terms of the money supply, which as Austrian economists, obviously we would consider inflation to be everywhere and always a monetary phenomenon.
Sure.
There's also changes in prices which follow monetary inflation or deflation, and that's what people commonly mean when they say the word inflation. They normally just mean that prices are going up. And then there's, of course, the situation with credit and debt. So you can have a increase in credit and debt, and you could call that debt inflation, or you could have a collapse of debt due to defaults, and that would be debt deflation. So you have these 6 permutations, so we just should be clear about which one we're talking about. I would start with the concept of monetary inflation, because we saw a huge run-up in credit and debt. So we saw a bubble, in fact, in real estate and other kinds of debt. And then we saw that bubble come unglued in 2008, and the whole system start to collapse, literally. This was essentially prevented by changing accounting rules, which is absolutely unsound as in terms of making the financial system stable or sustainable. But it works in accounting terms to make it appear that banks are still solvent. And then we saw a radically inflationary response from the government and from the Federal Reserve, exceeding $20 trillion, more than the entire GDP of the United States. So from a inflation versus deflation point of view, I think it's important to understand that both can happen in different ways at the same time. So you can have radical monetary inflation, which will cause prices to rise for certain kinds of things, especially imported goods. So here, from the point of view of the United States, we have a large trade deficit. Obviously, if we print a lot of dollars, the value of the dollar will fall. But if money is more scarce within our domestic economy, domestic prices won't rise, but the prices of imported goods will rise. So you can have inflation in that sense. At the same time, we're in the process of a slow-motion debt collapse. And I don't see any way of preventing that so that's debt deflation. And that I don't see any way of preventing that without the economy actually recovering, and that simply hasn't happened.
Right. So basically, that's why you see prices of imported goods going up, and a lot of other things like real estate. You see the prices going down because the money's not there to purchase, and the income's not there to service the debt. But now let's look at it that we also are seeing inflation or rising prices, which we really have to differentiate, as you stated. So we have rising food prices, rising commodity prices. How much more can food go up and, say, gasoline prices go up, where it knocks out demand for the other stuff, which causes those prices to kind of evaporate, and yet we're seeing like major inflation in those goods that we need to carry on life as we know it?
Yeah, the basic fundamental problem is that the dollar as a unit of measure is not stable. In fact, really none of the major fiat currencies are stable at this time, and I mean specifically the euro, the yen, and the U.S. dollar in particular. So this is the basic fundamental problem. So if you want to say what the price of something is, it's always what is the numeraire? So priced in what, for example. Mm-hmm. So when we say that the price of food is going up, that's another way of saying that the value of the dollar is falling.
Right, I see. So we're talking about a depreciating currency unit where a dollar is becoming worth less and less until eventually it becomes worthless, right?
Yeah, and it's a long, drawn-out process. There are many charts that you can look at that will show this ramp. But if you look at the credit and debt situation and the monetary base in contrast to that, you'll see that after 1971, we had an acceleration, essentially a hyperbolic curve, increasing the amount of currency and debt in our economy. And so this is a totally unsustainable phenomenon. And actually, if you just think about this whole idea of constant inflation, we have a monetary system that once the link to gold was broken finally in 1971, you have a system now that really must continue to expand. Otherwise, it will literally collapse. In other words, the amount of currency in circulation has to be continuously increased. Otherwise, debt cannot be serviced. And new lending, of course, creates money. So you have to have the level of debt and level of amount of money in the system continue to rise indefinitely. But any continuous increase that's, for example, 2% or 3% or 4% per year, that will become an exponential. It is an exponential function, and it will go hyperbolic. It will go vertical at some point. We've been on the vertical end of that curve now, and I'm talking about the acceleration that started in 71 and it went vertical by the end of 2007. That's not a sustainable phenomenon, and what we have is a situation where the system is fundamentally broken because the structure of the system, this whole idea of exponential growth forever, is a fundamentally flawed concept. This cannot be a stable monetary system. It will never be a stable monetary system.
So then the question arises, what was Nixon and Milton Friedman, who was the architect of the fiat money system, what were they thinking in 1971 that this thing could just continue onward and upward with no end in sight?
Well, they obviously, really didn't think through the end result. I mean, in reality, it was essentially a temporary measure. Simply what happened was the U.S. had already printed too many dollars, and they couldn't cover it with gold. So what they basically, Nixon closed the gold window, and this created a situation of the floating currency system that we have today, and the pure fiat U.S. dollar. So that was originally a temporary situation because, of course, the gold supplies were being depleted, and this was going to basically cause a failure of confidence in the U.S. dollar. So this was a temporary measure that has become a permanent system. So the idea that there's a grand plan and that the outcome has somehow been anticipated and planned for is perhaps a flawed notion. Although anyone who actually examines mathematically how the system works can easily see that this is not a stable, sustainable system. This whole notion of fractional reserve banking, it creates an inflationary system, and inflationary systems they require a constant rate of inflation. That's an exponential function, and that is not stable, and it can never be stable. So we have to have some other kind of monetary system where the amount of currency in circulation increases in a way that's much more consistent with population growth and with the increase in real economic activity in the actual economy, in the real economy, not in the financial system, which is what has happened. We've seen a vast expansion of monetary units in the financial system, but it doesn't reflect the real economy. The link is broken between the real economy and the financial system.
Right, and you raise a really great point. When I went to college and I took economics, they bragged about the American economic system, the monetary system, in that it was flexible. So when people needed more money, they had it. When business was expanding, there was a credit expansion, so it would aid business to expand. And they never talked about bubbles. They never talked about the downside of that, which is monetary inflation and the dilution or dissolution of purchasing power of those units. So is this Keynesianism, or is it just ignorance that we're talking about, Ron?
Well, Keynes himself was, in fact, a banker and had a post at the Bank of England for some time. So you obviously, look, realistically, a pure fiat fractional reserve system where private corporations can create money for their own profit, such a system, in theory, could work if banks would only loan out enough money to support population growth and real economic activity. Unfortunately, for several reasons, one of them being human nature, the other being whether or not you can have a profitable banking business on that basis, that's simply not possible. It's simply not possible. And because it's an inflationary system where the amount of currency has to expand to continue servicing debt, this is a problem that the system actually cannot, it has an inflationary bias, in other words.
Right.
It has to inflate or it will literally collapse. So that's the basic fundamental problem, the root cause, so to speak. So that's not Keynesianism per se. I mean, this is the nature of the actual banking system that's the problem. Keynesianism is a whole other dimension, this idea that the government should be a large active participant in the economy, and that concept is linked to central banking. Insofar as, in order for the government to be a large active participant in the economy, the government needs to have big financial guns, so to speak, and it can get large amounts of money if it's printed out of thin air by a central bank. So the two things are not unrelated.
Right. And the other thing is that because it's inflationary by its very nature, when the banks loan out this money, they're loaning it out pre-inflation. Their purchasing power of those newly created units hasn't affected the system yet, so they're worth more, and effectively they get to buy more with their money as they create it. So it's kind of inherently unfair that they are the beneficiaries of the inflation that they're actually going to create down the road.
Yeah, I mean, that's exactly right. I mean, in fact, there's really a couple of points here. I mean, one of them is that you have a system where it's legal for banks to trade fictitious property for real property or real production. In other words, a loan contract creates money, or swiping a credit card, it creates money in the financial system, in the economy. When that happens, the money was created ex nihilo. In other words, literally from nothing, out of thin air. So there's nothing backing it. So when the bank makes a loan, and it's a bit of a fallacy because we all sort of learn in school that banks take deposits and they keep the money safe and they pay a moderate interest rate if you keep your money in the bank. They take some of that money and they loan it out and they charge a fee for the use of that money, and that's how their business works. But in reality, banks are levered 10 to 1, 20 to 1, 30 to 1, 50 to 1. So actually, they're loaning out or leveraging the money they have on deposit to such a high degree that just the cash flow from the loans is more significant to the business than what the deposits actually are. So what they're in the business, they're actually in the inflation business. They're in the business of creating money. Now, the beauty of it is, at least for the banking business, that when they create money from nothing, it's paid back in real production. So while they actually just sign a contract and as a legal mechanism create money in the economy, the borrower has to pay that money back from for example, wages. So that's real property, or it's guaranteed by, in terms of loan collateral, by real property. So they're in the business of essentially trading fictitious property, paper, in other words, just a loan contract, for real wealth, for real production, for real property. So that's a wonderful business model for banking. The problem is, and this is the sort of the second part of this, is that this causes an aggregate or net flow of wealth and property to the banking industry. And this is a problem for the economy, because if it becomes too extreme, in other words, if the system sort of goes on long enough, then that aggregation will cause a disparity in the distribution of wealth that will actually cause economic activity to decline overall. And that's exactly where we are. Another way of saying that, which I think is absolutely non-controversial, is simply that debt levels in our economy are too high. The economy cannot sustain the levels of debt that exist today. So, now when you say the words distribution of wealth, you're often branded as a socialist or anti-American or whatever. Sure. Those labels are really quite meaningless, because the numbers are quite clear on this matter. That in fact, there has been an aggregation of wealth and property to the financial sector, which is even now 30% of S&P 500 profits. And so we just have to recognize that, look, this banking industry is too large for our economy. And now we all know that the government can be too large. In other words, government spending can be too large as a proportion of the economy, so that if taxes are raised sufficiently to cover the actual government expenditures, it will crush economic activity. There'll be a net reduction of wealth in society. So this idea that government can be too large, that government spending can be too much relative to the size of the economy, this is non-controversial. This is a constant debate in Washington, D.C. in every election as to, how much spending, how big can the deficit be, or should we have one, and should we balance the budget, and so forth. So this idea, everyone knows intuitively that there is an optimum size of government. We can argue about what that is, but this is really not debatable. But you never hear anyone debate about what is the optimal size of the financial services industry as a percentage of the economy.
Mm-hmm. Right. And got time for one more question. So you're the average person here. You've managed to hold on to a good chunk of your savings throughout this whole financial collapse, this economic debacle. What do you do with it? Is it gold, silver, precious metals, hard goods, energy? And perhaps we're going a little astray, but what's your personal feel on that, Ron?
Well, no, I think that's right on target. I mean, look, the reason that I'm doing what I'm doing now is that I want to preserve my own wealth and hopefully pass it on to my children. And I want to find a way to grow my wealth, not just preserve my wealth, but grow it, even under these circumstances when the financial system is unstable. We have literally an unstable monetary system. We have a declining economy that arguably is also unstable. It simply is unsound based on our trade deficit and so forth. So under such circumstances, how can we preserve our wealth? Well, the most immediate problem, I think, is the financial system. And so my own view is to really get part of my wealth out of the financial system in physical hard assets, including precious metals. And in addition to that, move financial investments, and this is what I'm talking about, what I've personally done, move financial investments into businesses that actually have physical assets. So the vast majority of my investment portfolio today is in natural resources, and that is my principal occupation, is studying natural resource producer companies from the point of view of investing, and that's what my newsletter covers as well, is natural resource investments.
Great, and we really appreciate you coming on, Ron, and telling us, sharing with us your unique historical perspective of the economic collapse, where we're heading, and what you can do about it. If someone wants to find you on the internet, on your website, where do they go?
Just HeraResearch.com. It's HERA research.com, and you can read all about the companies and the newsletter and everything there.
Yeah, that's excellent. And if anybody has a question for Ron, send it to me at kl@kerrylutz.com. The next time I talk to Ron, I'll ask him about it, or I'll email it to him and get you an answer back. Thanks so much for being with